A second key impact of the financial crisis was, of course, on confidence. When people thought that they might even lose their money market accounts, they basically hunkered down and stopped spending, and that has also been hurting the economy. We've had a massive destruction of wealth, both housing wealth and stock market wealth. And we economists follow the work of Franco Modigliani, the famous Italian Nobel Prize winner, who estimated the effects of wealth on consumption. He estimated that if you lose $100 billion of wealth, you'll lose about $3 to $4 billion of consumption, a 3 to 4% decline. And that's the kind of declines that we've been seeing. It's the data that we've been seeing is in line with the analysis of Modigliani. Well, when consumption is 70% of your economy and it's declining for these factors, you end up with a pretty deep recession, and that's exactly where we are. Let me turn now to my second question, which is some principles for regulating the economy, for reforming regulation. Obviously, this is a very relevant topic. I know we'll have a good discussion of it here today. It's in the U.S. authorities, EU authorities are proposing regulations. The U.S. Treasury issued a draft white paper last week with some principles for reforming the regulation system. I can tell you my main thought for regulatory reform in a very simple sentence, and that's it. It requires a very delicate touch. If we under-regulate our markets, we can end up with markets in which no investors have confidence and we don't have productive investment and innovation. If we over-regulate our markets, we will discourage useful and productive investment. In either case, we would suffer a loss of living standards over time, and that would not be good. What we need to strive for is smart regulation, regulation that adapts to changing technology and changing circumstances. Now, I think there are two key failures of regulation in the recent financial meltdown. First, regulators allowed financial firms to employ rates of leverage that were just simply too high. They did not force the firms to consider systemic risks. When times are good and the economy is growing and financial asset prices are stable, high leverage ratios allow firms to earn high profits. Well, that's great. But financial firms in any 5 or 10-year window will face less than perfect conditions. We know that. In any 5 to 10-year window, there will be unanticipated inflation, there could be a collapse of commodity prices, there could be a stock market decline, it could be a recession, and leverage ratios need to be moderated or restrained so that firms can earn a fair profit in the good times, but they can survive the bad times. I think that firms need to basically be stress testing their portfolios based on realistic risk assessments. The question isn't just, can I suffer a reversion to mean? The question is, can I suffer an overshooting on the downside? If we look at 1998 and the collapse of long-term capital, this was the clear message. You can't, not just can I withstand a return to mean, can I withstand an overshooting on the downside? The second key failure of regulation was that it forgot about transparency. Transparency requires that the market participants, the investors, the regulators, that they understand what's really going on with some of these instruments. What happened during the financial crisis was many of these financial instruments were so complicated that they could not be understood, even by the managers of some of the financial institutions. Some of these mortgage assets were sliced and diced 5 times and 6 times based on complex statistical rules and complicated valuation formulas. Basically, they were just not understood, even by the top folks. This is one reason why I like the proposal to not allow the trading of these instruments on the over-the-counter market. I prefer to see them moving onto the regulated exchanges so that we have a basis for understanding what the facts are in terms of what these things are. A very complicated question is the mark-to-market question. Now, generally speaking, mark-to-market is very good. In normal times, Mark-to-market allows a logical accounting of an instrument's value. The problem is in cataclysmic times like we've had, or a financial downturn, it's very possible for these policies to give a pro-cyclical bias. And of course, that's something that we've been wrestling with the last couple of years. If you force a synthetic calculation of an asset's value in a non-functioning market, you basically might actually compound the problem. I would say the lesson from this is that any modification of the rules has to be done very carefully and probably on a temporary basis until we really understand exactly what the dynamics are. Let's talk about derivatives for a minute. There's been a lot of debate about financial derivatives, whether they spread risk and so on. Alan Greenspan, again, was famous for famously quoted as saying, oh, derivatives, they allow us to offload risk and make the market safer and so on. Well, that's what he was saying a couple of years ago. I would agree that derivatives can offload idiosyncratic risk. For example, if there's an automobile company that's going to default on its bonds, credit default swaps can help to ensure that a pension fund that owns those bonds can have effective insurance. Now, this is great. There are retirees who are supported by the pension fund that's being paid by that bond, so this would prevent losses. That's a great thing. Even in the 2001-2002 recession, I think derivatives actually softened the recession. It made it not as deep as it otherwise would have been because we still had pretty good credit supply the whole way through that recession. The lesson of the current crisis, though, is that financial derivatives can increase systemic risk if you have a more severe episode. That is, up to a certain point, these interlinked financial instruments can improve risk-return outcomes, but if you get past a critical point, you actually make the system less safe. The key, of course, is if you get to the point where certain well-known, well-appreciated financial institutions start to be questioned whether they're going to survive, that's when you know you're getting into the systemic problem. Now, financial regulators need to wrestle with these issues, try to identify appropriate regulatory standards. I think in general we need less leverage. I think that's a clear lesson, and we need higher capital ratios. I think those are two clear ways to reduce systemic risks. I have a very simple test that I would pose to any regulator or manager of a financial institution. Anytime the price of a major asset class increases by 200% or 300% in a short number of years, and this could be home prices, it could be gold or oil, it could be Dutch tulips, it could be technology stocks. Anytime you see a major run-up in the price of a class of assets, you have to ask yourself whether your business model or whether the structure that you're regulating could tolerate a rapid return to a historical trading range or an overshooting. Now, having said that, I will say capitalism is not neat and clean and tidy. And many of the most important advances of capitalism have not been incremental, they've been jarring and major shifts. Sometimes in capitalism, we need to mass capital and in order to get breakthroughs. And, Joseph Schumpeter wrote about this process. And sometimes the cost of unwinding a problem can actually be worthwhile. Think about the dot-com bubble, for example. One could argue that despite the massive losses in the dot-com bubble, the massing of capital, the information revolution that it helped to bring about, has improved living standards in important ways. So I think we have to keep this at the back of our minds. Let me now turn to my last question, which is, what do we do about global governance? What should be the response to the crisis? As you know, a number of people have lots of suggestions. They say the G7 or G8 should be expanded to the G20. Or they say we should create a new G9 or a new G10, including India and China.